Stop saving money blindly. It's one thing to save money. It's another to do it in a way that not only benefits you now, but also into the future. If you're single and you make less than $146,000 a year, or if you're married and you make less than $230,000 a year, there is an optimal order to saving your money. In this video, we're going to go through 7 steps that you should take to save your money to get the most bang for your buck. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And if you are actively saving money, I want you to ensure that you are doing it as efficiently as possible. And the specific efficiency that I'm talking about is tax efficiency. The younger you are, the more important tax planning is going to be when it comes to saving for your financial future. We are all very well aware of the current financial state of our country and the hole that our country has dug itself in. Unfortunately, the only way out of that hole is increasing taxes. And I'm not talking about the taxes that the rich people pay because they have endless options when it comes to avoiding their tax bill. What I'm talking about is the taxes that you and I pay, or middle America. Like any plan that our fearless leaders come up with, it's not the rich that pays for those plans. It's middle America that ends up shouldering that burden. To keep yourself from having to shoulder too much of that burden, you need to make a plan for your savings to be tax efficient now as well as in the future. The first account that you should save money into is your savings account at the bank. And the whole purpose of this pool of money is to act as an emergency fund. And I know you've heard of emergency funds, and you've probably heard of all of the rules of thumb about how much money should be in that emergency fund. But for me personally and the clients that I work with, before you begin investing, you should have $1,000 per person in your household sitting in cash. So if it's just you, it's $1,000. If you're married, it's $2,000. And then if you have children, you add $1,000 for each of those children. And what this does is it creates a pool of money that's going to get you through almost any immediate emergency. And then ultimately, it's going to help keep you on track to keep saving for your future. Once you've saved up that $1,000 per person in your household, the next account type we need to look at is your employer-sponsored account. And an employer-sponsored account could be a 401k, 403b, 457. It all depends on the institution that you work for. But with these accounts, you are typically going to be eligible for a match of some sort. And this match is going to be based on the amount of money that you put into the account. It could be a dollar for dollar match, could be a 50 cent on the dollar match, but depending on what your HR department decided, you could be eligible for free money just by participating. So if you make $100,000 a year, your company offers a 5% dollar for dollar match, you put in $5,000, your employer puts in an additional $5,000. And this is a guaranteed return on your money. You didn't have to invest your contributions, you simply had to participate. So putting in enough money to at least get that full company match should be your goal with this account. And I don't want you to leave that money on the table. Your employer is offering that benefit to you for working for them. So if they're willing to give you money just to participate in their program, you should take it. They expect everything out of you, so you may as well get everything you can out of them. Now, you do need to keep in mind that the money that you put into these accounts is going in on a pre-tax basis. What this means is you get to save on taxes now, but you're going to have to pay taxes on it later when you withdraw the money. So once you're putting in enough money to receive your full company match, I want you to stop, at least at this point, because the goal is to ensure that we're not paying too much in taxes later on. One other thing about a 401k that I want you to keep in mind is that you may be subject to a vesting period. And what this means is that the company match that the company provided for you may not be 100% yours until you've worked for them for a certain period of time. So if you plan on leaving and you're not 100% vested in their plan, then they can take back some of their contributions. After you're contributing enough to receive that full company match, the next thing we want to focus on is your high interest debt. Now, high interest debt and what it is up for debate. It could be anything that you deem reasonable. But for me personally, I think of high interest debt as anything 8% or more. The reason that I chose 8% or more is because there's nothing that you can invest in that's going to guarantee you that rate of return. Sure, You can invest your money in something that's returned 8% historically, but it's not guaranteed. If you use your additional cash flow to pay down your high interest debt, your rate of return is the amount of interest that you save, and it's guaranteed. So to pay off your high interest debt, we're going to list out all of your debt with an interest rate of 8% or more, and we're going to snowball your payments until that debt is gone. So starting with the smallest balance, you're going to take all of your additional cash flow and add it to that minimum payment. Once that debt's paid off, you're going to take all of the money that was being paid on that debt and add it to the minimum payment of the next debt. And then before you know it, all of your high interest rate debt is going to be gone. Once you've paid off all of your high interest debt, the next account type we want to look at is a Roth IRA. And the Roth IRA is where the tax efficiency of your savings really comes into focus. With your employer-sponsored account, you're contributing money on a pre-tax basis, meaning you get to save taxes now. The money that goes into the account gets to grow tax-free, and then when you retire, you withdraw the money, but you have to pay taxes on it. With a Roth IRA, you fund that account with after-tax money. The money you contribute still gets to grow tax-free, but then once you turn 59 and a half and the account has been open for at least 5 years, all of the money that's within the account belongs to you with no taxes. Because you don't have to worry about paying taxes on any of the money you withdraw, you can fill any income gap that you have and not have to worry about increasing your tax bill. As of 2024, the contribution limits for a Roth IRA is $7,000 if you're under the age of 50 and $8,000 if you're age 50 or older. After you've maxed out your Roth IRA, the next account type that I want you to consider is an HSA, or a health savings account. Now, the HSA isn't for everyone, but if it fits your situation, it could be the hidden gem of your retirement planning. The reason that the HSA can be so vital to your retirement planning is due to the triple tax advantage that it offers. With the HSA, the money that you put in is tax deductible now, meaning you get to save on your taxes when you contribute the money. The money within the HSA can grow tax-free, just like the 401k and the Roth IRA. And then if you withdraw the money for a qualified medical expense, it's tax-free. Now, what a qualified medical expense is all laid out by the IRS, and I'll put a link to that form in the description of this video, but that list is quite extensive. Now, with the HSA, it is not meant for everyone. There are rules to participating in an HSA. The major rule is that you have to be on a high deductible health plan. For a lot of people, a high deductible health plan may not be the right option. If you go to the doctor frequently or you have to take prescription drugs on a regular basis, then being on a high deductible health plan may not be the best decision. And if that's the case, then the HSA isn't going to be available to you. But if you're healthy and you don't visit the doctor often or you're not on a lot of prescription drugs, then a high deductible health plan may be the right option for you. If that's the case, then you can utilize the HSA to save for your healthcare expenses in retirement. For 2024, the maximum contribution, if you're the only one covered by your high deductible health plan, is $4,150. If your whole family is covered by the high deductible health plan, then your maximum limit is $8,300. And then if you're over the age of 55, you can add an additional $1,000 to your HSA in 2024. If you've made it this far and you still have the ability to save more, then I want you to consider maxing out your 401ks. Now, I know earlier in the video, I said that any of the money that goes into a 401k is going to be taxable later on when you take it out. But if you make less than the Roth IRA income limits, then your effective tax rate in retirement is most likely going to be equal to or less than your effective tax rate now. Also, if you've maxed out a Roth IRA as well as an HSA, you can use those accounts to help manage that tax bill. For 2024, the contribution limits for anyone under the age of 50 is $23,000. If you're over the age of 50, your maximum contribution limit is $30,500. If you haven't disagreed with me up to this point, now's your chance. If you have maximized all of the other savings options that we've gone over so far, then I want you to focus on paying off your debt. Now, you don't necessarily have to pay off your mortgage, especially if you were able to lock in a 3.5% or 4% interest rate, but all of the other debt that you have, get rid of it. And I know there are other account types you could use to continue saving money. But if you've maxed out your 401k, if you've maxed out a Roth IRA, and if you're married and you've maxed out an HSA, as well as your spouse's 401k and their Roth IRA, then you could easily be pushing $70,000 a year in savings. I think any retirement plan is going to have a high chance of success if you're saving $70,000 a year. So if you've maximized all of those other savings options, I want you to focus on getting rid of all of your non-mortgage related debt. And then once all of that debt's paid off, you can take that additional cash flow and put it into those other account types. Everyone's going to have their own opinion about how you should go about saving your money. You could change the account types that we went over, you could change the order that we went over. It's all individually based. But for me and the majority of the people that I work with, this is the optimal order of saving money. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone and they're just starting on their savings journey and they're not sure where they should begin putting their money, then send this video to them. Maybe it'll get them on the right path. But I want to thank you so much for tuning in. I'll talk to you soon.